Welcome back, traders. John Caruso coming to you here with a midweek update. It is Wednesday evening, February 15th. We're recording for Thursday, February 16th. I'm going to try to keep this as tight as possible. We're going to go through some of the data that we've seen to date, as well as taking a look at some of the price action on the charts and how some of these markets have responded. So, first off, Tuesday we did see CPI come out a hotter than expected number on a year-over-year basis, up 6.4% year-over-year. The market was looking for 6.2%. So that was a hawkish number that we saw in terms of the CPI number. And then, of course, this morning we did receive retail sales that came out. Of course, the consumer represents 70% of the economy and GDP. So retail sales is certainly a heavyweight inside of that, up 3% month over month. That's a blowout number in retail sales. The market was expecting up 1.8%. So the inflation data week to date has been very inflationary and hawkish. We did see industrial production come out. Industrial production is a heavyweight inside of GDP, and that did fall flat at 0.0. Market was looking for up 0.5%. So dare I say we've seen kind of a mix of some stagflationary data to date, with the inflation numbers reaccelerating in January and the growth figures beginning to decelerate in January. CME Fed Watch, following the inflation data this week, we did see the CME Fed Watch now begin to price in a 50% chance that we could see the Fed move to 5.5% on the Fed funds rates. No one's been talking about 5.5%. Everyone's been at 5% as a base case, maybe 5.25%. Now the Fed funds markets are beginning to price in the rising odds of a 5.5% Fed funds rate come the June meeting. So I thought that was the most noteworthy move that we've seen this week. And that has come in, of course, the Fed funds futures markets and the bond market. We do have the 10-year yield right now at 3.81%. We've got the 2-year yields now an earshot away from the cycle highs as well. And of course, the 2 and 10-year spread did reach a new low today at minus 87 basis points. So all very noteworthy. A lot of stress on the yield curve right now, and I think that is soon going to be catching up in the equity markets as well. So let's jump over to the charts here quickly. I'm going to try to run through these quick and keep it as tight as possible. Clearly, what I'm staring at here in the March S&P 500, clearly this upward bias in this market, we have been channeling higher. We're up about 6%, a little bit over 6% to date. That's since the start of the year. Or the last 5 or 6 weeks in the market. So we have put a lot of weight on in this market in a relatively short period of time, but the bias still remains higher in the S&P 500. I do not have an overbought signal yet. I do have positive momentum. We would call this bullish trade on the charts, but I am starting to see the top end of my range start to register a lower high, which is very interesting. Last week, we did have the top end of the range up around 42.20. As it stands here this evening, we're sitting at about 42.08. So that is a lower high over the near term. We do have this drawn in that we expect this to continue to attack that 4,200 area before we begin to start to see some signs of rejection. And we do think that there is a big period of risk that lies out in the March and April timeframe for the S&P 500. If you want to ping me and learn some of the reasons why and what some of our growth and inflation models are predicting, feel free to ping me and we can add you to our morning market insight letter as well. So that's a look at the S&P 500. We're going to jump over to the VIX. This is further evidence why I think the S&P 500 could be in a period where we are getting close to topping out, or a period of exhaustion in stocks. Clearly, what you can see in the VIX, we did see this market channeling lower here, negative momentum, and then we did see that burst higher, and that was on the recent move back on the downside in the stock market. That was following Powell last week, where we did see the S&P 500 trade as low as, I believe, 40.70 on the downside, and that spurred this increase in volatility. Now, volatility over the last 3 sessions has been channeling back on the downside. We did see VIX expiration was today, so sometimes you do get some artificial suppression of volatility going into expiration, and perhaps that's something that we have seen here to date. So while we were moving lower over here, we had negative momentum. Now the momentum changed to neutral. We have neutral momentum, and I am registering an immediate term oversold signal down here in the VIX. So I do think volatility, we are on the cusp of seeing volatility begin to pop back on the upside. And altogether, I do expect, or I do think that the VIX contract right now is similar to holding a ball underwater. I think it's only a matter of time before some of the great growth data comes in, begins to decelerate here in the economy, and we will see the CBOE VIX index begin to find some footing back on the upside. So that's more evidence why we think on the charts, why we think the S&P 500 could begin to show some signs of rejection up around 4,200. So I remain agnostic. If the data changes and the chart change, certainly we will change as well. But that's how I am seeing it as of here this evening. Let's take a look at the gold market as well. Gold is interesting here. It still remains bullish trend inside of our model. Clearly, we had that massive rejection off the 78.6 Fibonacci level, and we have done nothing but channel lower since. I do have a breakdown of momentum here. We are now negative momentum. The one thing that bothers me about gold, it certainly looks interesting down here from the standpoint of a value play based on how far it has fallen in a relatively short period of time. A couple of things are bothering me about gold right now. Number one, the low end of my range continues to drop out. So the low end of the range as of this evening is about 1831. That is down from 1839 earlier in the session here today. So that continues to fall out. 1831 low end of the range. And I am getting this negative divergence in my oscillator down here. This is my overbought, oversold indicator, where the overbought, oversold indicator is trending back towards overbought. While price action is still moving on the downside. That's a negative divergence. That coupled with the idea that the low end of my range is dropping out, I'm staying away from the gold market right now, even though it looks attractive from the standpoint, okay, we have fallen a long ways, but any, upside traction that we can get up into this area in the gold, maybe we do get a little bit of a bounce back. We are bouncing here this evening. I think the upside is going to be very short-lived, and we will once again break down in the gold market. So I am not getting a signal to be in there as a buyer of the gold market just yet. So that's very interesting. And I'm also going to take a look at the US dollar and what we see in the US dollar and how that relates to the gold market as well as the S&P 500 market. So taking a look at the dollar right now, clearly we've seen the US dollar was channeling lower right now, but this entire way, believe it or not, it's been holding my longer term bullish trend line. So clearly we got close to it. That's a weekly look at the dollar. Clearly we got close to it and we rescued it. It rescued itself. And that was off of Powell, where the market perhaps read some more hawkish, caught some more hawkish vibes than what some of the other markets did from Powell. And it rescued itself. And now I'm going to zoom in again. What this looks like to me is we do have momentum now moving positive in the US dollar. It looks like this is kind of a bullish flag that's developing. Maybe we get another wiggle down in here to 103, but I think eventually this market's going to try to reattack this 105 to potentially this 106 area. I do have a period of risk once again drawn in for the US dollar, but that ultimately may end up being correct. And that period of risk may actually live somewhere deeper out here, May, June, July timeframe. I don't know. Of course, we're going to monitor that going forward. But to me, if we do get a little bit of a wiggle down in here in the dollar, I do eventually believe that will be bought, and that's going to be a good buying opportunity for higher price action in the U.S. dollar. And dollar versus the S&P 500, there has been an inverse correlation in there for the better part of the last couple of years, where the stock market trends higher, dollar trends lower. Dollar begins to trend higher, the market, the broader stock market begins to trend lower. And of course, you can, the inverse correlation that the dollar and the gold market actually holds. So interesting. We are seeing rising interest rates right now, a rising phase in the US dollar, a declining phase in the gold market. And I think it's only a matter of time before we begin to see that declining phase take hold in the stock market somewhere potentially towards the end of this month, March and April. So that is a look at the US dollar and how that relates to some of the other macro markets that we follow. Let's lastly take a look at the crude oil market. This is a market been we got a very mature downtrend here in the crude oil market. Now we have just basically, since the end of last year, carved out this sideways range. It's about an $11, $12 range. We're going to call the top side about 83, and we'll call the low side about 71 to 72. So as I'm taking a look at the crude oil market, just largely range bound. We did see a breakdown in the beginning part of towards the end of January, beginning part of February. It has since rescued itself. Perhaps we can chop a little bit higher in here into the top of the range before we begin to start to see some rejection and see that rotate back to the downside. Now, if we were able to close and punch above 83.50 convincingly, that is going to set off some red flags in my mind, suggesting that something is changing, and perhaps something larger is going to live on the upside, going out in the March, April, and May timeframe. I don't know what that would be. Perhaps it could be something geopolitical that would scare energy prices on the upside and scare equity prices back on the downside. I don't know what that potentially could be. But right now, some of the evidence suggests that this is a mature downtrend. If we do reattack this 82.50 to 83 area, I have no reason to believe that we're going to punch through there and then be on the lookout for potential rotation back down to the low 70 range in crude oil. So I hope all of that was helpful for you. If you are joining us from Paradigm Futures, welcome aboard. If you want to follow us with our market insight letter, feel free to reach out to Jamie at paradigmfutures.net. And I would be more than happy to add you to that list and answer any questions that you guys might have. So best of luck to everybody out there. We'll catch you back here next time. Take care.